Hi, everyone. I'm Doug Alsdorf, the author of Financing Your Future. This is chapter 10, where we're going to have a look at how many stocks should I buy? This is the fourth of 9 chapters on investing, and this is where we're going to begin to move away from buying individual stocks to where we're going to want to buy a collection of stocks. And we'll see in the future chapters, we actually want to buy more than just a dozen stocks like we're going to talk about in this chapter. So, based on chapter 7, 8, 9, a solution to buying the problem of buying just one stock, remember, there's a lot of risk in buying just one stock, is to spread the risk and buy several stocks. The chances of them all going bad at once is pretty limited compared to just one or two going bad. So let's examine two portfolios of, say, 10 and 11 stocks, call it a dozen if you like. We will see that it's still difficult to build a portfolio that's resilient when just one or two stocks are responsible for the gains. And this is ultimately in the future chapters going to lead us to the same conclusions that well-known investors such as Malkiel and Bogle and Buffett have suggested, which is owning a broad market, passively managed stock fund and reinvesting dividends reduces risks while creating gains when measured over decades and decades. We're going to come to that in the future slides or future presentations, future chapters. And always please keep in mind, nobody can promise you investing success. So let's have a look at a portfolio of, say, 10 well-known companies. And these are just 10 companies I picked. This is Doug's portfolio that I just created. And I didn't do anything special here at this. I didn't sit there and analyze their fundamentals or their performance, their histories. I just said, I'm going to pick 10 stocks that I'm familiar with. Facebook, Tesla, Ford, Starbucks, Chipotle, Microsoft, Chase Bank, Mattel, a toy company, Exxon is a oil company, and Johnson & Johnson. Kind of a spectrum of companies here. They're not all from the tech sector. They kind of spread across through there. So we have a kind of a diverse portfolio in terms of which sectors they're coming from. Keep in mind as we look at these upcoming slides that when we start in mid 2012 and going forward, that's a decade until 2022, a decade of a bull market, a fantastic bull market. Starting in mid 21 or thereabouts, that's when the Fed started fighting the inflation by increasing the interest rates. Okay, so here is those portfolios. So right here is those 10 stocks. We invested $10,000 total. And so we'll see in a minute how much money was in each stock. So we invested those all the way back here in January 2012. And we see that this portfolio with all 10 stocks, man, it really took off. It did great, up around $175,000 after about 10, 12 years. But it was all because of Tesla. If we subtract Tesla from that portfolio of 10 and just invest $10,000 in 9 companies, then we make a far, far less amount. And instead of guessing or hoping to pick 10, 12 companies that are really going to perform, instead what we could do is just buy VOO, which is Vanguard's broad market fund that follows the S&P 500. So this green line is easily available, doesn't require any thinking. The blue lines and red lines require us to carefully assess and think about every single company that's in our portfolio of 10, 11, 12 stocks and reminds us that we really got to carefully, watch them and make certain that their prices are doing well. And then we get caught up in that emotion of buying and selling. That's for the blue line and red line. But the green line, you just buy it, walk away. We'll see more of that coming up in future presentations. So that was with a great bull market happening right in through here where I'm moving the pointer. Let's say instead we didn't buy back then at the start of the bull market. Let's say we started here in January or mid 2021. Let's say we bought those same stocks then. Then what would happen? They're all the same. Oh, that's really challenging. So in order to capture the gains that we saw in that previous slide, not only did we have to pick Tesla out of our 10 stocks, we actually had to pick it several years ago. Right now, sitting here today, can any of us pick the next Tesla? Tesla did not carry forth in this 3-year timeline in through there. So we need a new Tesla to pick. Who is it? I don't know. Think about all those previous plots that I showed you, Starbucks and Chipotle. Those companies are still around, still making food and so on. Can you predict their future prices right now today? It's really difficult to do this. Okay, maybe 10 stocks that Doug is picking aren't exactly the right stocks. Maybe, he's just a professor. What does he know? And I I would totally testify that's true. What does he know? Instead, let's go to some experts. And Morningstar is definitely financial experts. These people are absolute pros. So I Googled in February 24, I found this article, and you can go to the article, and they published in December of 21. They suggested these 11 stocks are the ones you should own. And they quote, these wide moat companies have positive moat trends and exemplary capital allocation ratings. A lot of jargon there. So if you Google some more, you find out that Morningstar's rating for economic moat, in other words, what does this moat mean? It means that the companies will capture how likely they are to keep their competitors at bay for an extended period of time. The article goes on to say that that extended period of time is 2 decades. So Morningstar is suggesting these 11 companies are going to be winners for 2 decades. All right, so let's see how well they're doing so far from January 2022, when we could have first read the article in December of 21. So we made our purchase, and here's all those stock prices. I'm going to move me out of the way. And we see it's just kind of a spaghetti bowl of stock prices, with the exception of that one right there. Look at that one. That one is standing out admirably so. This one kind of a little bit, but really it's this one. That's NVIDIA. That is NVIDIA that everybody is talking about these days. They're involved in artificial intelligence. AI is their thing, and they are spectacularly doing well. But it's really hard to see in the spaghetti bowl of stocks how well they're doing. So let's just look at a table of stock of their returns. So this is the compound annual growth rate, and that formula is available to you in the investing formula spreadsheet. So this is the growth per year. So this would be like the return per year. And we see NVIDIA from January 22 to August 24 is nearly 60% per year return. That is spectacular. But not all the stocks of those 11 did spectacular. In fact, if you do the entire portfolio, what is its return? 10%. Very good return, particularly considering this was during the time when the Fed was fighting inflation and stocks were actually dropping in price. We'd be really happy with that. But if we delete NVIDIA, just one stock, now the return of our other 10 stocks is only 3%. Not even better than had we just simply did the no-brainer, which is buying the broad market fund VOO in this case. Okay, so like we just saw, my selection of 10 stocks, Morningstar selection of 11 depended on just one stock. So conclusions. While an investor can do spectacularly well with just one stock, like Nvidia, fantastic. We can also do really bad with one stock, like BlackBerry. When selecting stocks for a portfolio, it's not clear if the selections are based on skill or luck. I had Tesla out of 10. That seems more like luck to me. At least I think it was luck on my part that I chose Tesla. I can't really know for sure whether Morningstar's selection of Nvidia was luck or not, but out of 11, they only had one that was doing well enough to raise their portfolio above the overall average, which anybody can go by without even thinking. In this case, that was VOO. So I actually think a lot of this stock selection is luck, not actually skill. When buying or selling an individual stock, timing matters. But we can't go back in time. We can't get in our Wayback Machine and go back and buy today's winners and therefore come out winners. And we also can't go forward in time to figure out which stocks today are going to be winners in the future. Obviously, we cannot time travel. I know everybody knows that. It's obvious. So how are we going to pick the winners of the future? Really challenging thing to do. And that's why we're going to see, and we're already getting hints of it, we may want to just buy the broad market index funds like VOO.